ये ऐसे कैसे कि इसका ठीक नहीं है? क्या इशू हो सकता है? कैसे हो सकता है? तो जो लैपटॉप सबका डाला है।
Good morning.
Good morning, sir.
Good morning.
Hi, good morning.
Morning, Shruti.
Hi, good morning, Sriram. Good morning, Mr. Vishwanathan. Good morning, Shruti.
Good morning, Vipin.
Looking
Good
forward to
morning.
Good morning, Vipin.
Good morning,
yeah,
Vipin.
looking forward to the webinar.
Yeah, same here.
Yeah,
Hi, Vipin. Long time no see.
yeah, absolutely. Long time. You become chairman now, no? So you're very busy. So yesterday in the evening, we sorted out how we will run the webinar.
Yeah, I had a chat with Sriram because I was not able to.
We've discussed. I don't think we've sorted out. Sorting
Yeah.
out happens only on the field.
And we are going to leave some time for Q&A at the end, or we're just going to respond to some uh, things which come up in the comment box.
Well, we'll go by the time, but Q&A through the chat is something that we thought we'll accept. We don't want somebody to come online and give a parallel workshop.
Absolutely. Absolutely.
So that's what was broadly discussed yesterday.
Yeah.
So if
So
there's any
somebody will look at that and decide these are the questions we'll answer, right? It's possible there could be a
yeah.
chat, so maybe somebody can take that. You will do that, right,
Well,
Professor?
3 years of online conferences, 2 years of COVID, and then overhang. We've got used to it.
Yeah, I know.
We're just waiting for the next generation who says, "What was COVID?" I already have this generation which says, "What was global financial crisis?" That
Right.
last
Yeah.
So we are waiting now for Vivek
and Sadaf.
and Sadaf. Yeah.
And I don't know.
Also, I'll just check quickly if I can share my screen just to be on the safe side
Yeah.
so that, there's no issue while. Yeah, my screen is visible, right?
Yeah. The
Okay.
sewing
Hello,
machine.
good morning, everyone.
Sewing machine is very
Sadaf,
clearly
how are
visible.
you? Good morning.
I'm good, Vipinji.
Thank you.
Good morning, Gigi. Good morning.
Morning, sir. Morning. Well, this is webinar. I'll come later when I need you or you have to sign your online contract.
Hi, Gigi. Good morning.
Morning, Vipin. Good morning.
Congratulations for pulling this webinar off.
Thank you.
Gigi is on a roll these days.
Oh, yeah, he is.
What is it? So we can't see the participants here, huh? In the screen. We don't see.
No, I don't think we can see the participants.
Am I audible?
Yeah, Sudhir.
Yeah,
Good.
Sudipta.
Hello.
Yeah,
Yeah,
you're
am I
audible.
audible, sir?
Very
Yeah.
Okay, thanks.
Looks like
Just
we said,
waiting for
looks like we are not audible.
pardon.
We said yes. Looks like we were not audible.
Right.
Okay now? It's okay, right?
Yeah, am I audible? Good morning, everyone. Good morning, Gigi sir,
Yes, sir.
Shri,
Good morning, sir. Good
Shri,
morning.
Morning.
Vishwanathan sir. Hi,
Good
Sudipto.
morning.
So just waiting for Vivek ji to join. So once Vivek ji joins, maybe we can also
I
start
think
off.
Vivek ji has joined. Good morning, Vivek ji.
Vivek,
Good morning, sir. Good morning.
hi, Vivek ji, good morning.
Good morning, sir. Good
Morning.
morning, sir.
Mhm.
Good morning, sir.
So we'll wait for two.
Yeah, we'll wait for
We'll
2
wait
more
for two
minutes.
more minutes and then formally start the webinar.
So Sudipta, you'll do you'll kick off the intro and then hand it over, or
Right,
Yeah.
right. So I'll start off with the introduction and then maybe
hand it
I'll
over to
ask
Shruti.
you to speak 2 minutes and then subsequently Shruti and you can take it over.
Sure.
Vivek, do you work on Saturdays also?
Yes, sir.
Do you work on Saturdays as well?
First Saturday is off, sir, and we are planning for fourth Saturday. But I think from October we will be having fourth Saturday off. But first Saturday is off.
I was just saying that every Saturday I go to Noida and I see this very imposing building of yours, and I'm very tempted to kind of walk in and say hi to you.
Yeah, you can come any day, sir. Any day when you are having time. Just first Saturday is off as of now.
All right, okay. So that is 10:30, 11:30.
Vipin, few more people are joining in. So just wait for another 2 minutes and then we can start it.
Another
Any
2
idea how
minutes.
many participants are joined?
We have
We have
51
around
and we have 52.
52 odd.
So I think we should start, Sudipto. We have now over 60 people.
Okay. So great. Thank you very much. So good morning, everyone, and welcome to the webinar on the way forward for microfinance in India. So this webinar actually has been organized in collaboration with Sa-Dhan, and this is one of the flagship initiatives of Access Development Services. This is part of the flagship initiatives of Access Development Services, the Global Inclusive Finance Summit. So as a run-up to this particular event, we have a series of webinars which have been planned. So this is the first of its kind. So to start with, it's my privilege to introduce the esteemed panel for the session. For the webinar is basically we will start off with a brief presentation by Shruti Joshi of Equifax. She will be presenting the current status of the microfinance based on the credit bureau reports and credit bureau documents which she has received. And then obviously the webinar has been moderated by Professor M.S. Sriram, a financial inclusion expert. Uh, and then we have Mr. N.S. Vishwanathan, former Deputy Governor, Reserve Bank of India, as one of the esteemed panelists, and two eminent microfinance representatives, Mr. Sadaf Saeed, CEO of Muthoot Finance, and Mr. Vivek Tiwari, MD and CEO of Satya Micro Capital Limited. So without much ado, I would like to hand over the session to start off. But prior to that, maybe I'll request Gigi to just give a 2 minute introduction about the particular seminar and the collaboration which we had with Sa-Dhan in organizing this particular webinar.
Thank you, Sudipto, and good morning to all. Let me also welcome everyone, all the participants, as well as the esteemed panelist, moderator, Professor Sriramji, Vishwan Sir, Sadapji, Vivekji, Shruti, all for this joint collaborative webinar between Sa-Dhan and Axis. I really thank Axis for making this possible. In fact, it's an idea emanated from Mr. Vipin and Sudipto, and I thank you for that. In fact, this webinar, I feel it's an important thing. especially at a stage when the microfinance sector is undergoing certain kind of challenges. In fact, we have been seeing certain challenges in the past also. We have, over the last 25 years or 30 years of microfinance sector, we have seen several such challenges, but they were all external. It was all based on some external event. This is one thing which is happening because of some inherent issues within the microfinance sector. So probably this is an important event, and it's an event to look inside and look how do we go forward. So that is exactly that this webinar is trying to address on. So because earlier things, when something else happened out, some external event happened, we were able to overcome that because after the event was over, the things got into shape. But now this particular thing, it is because of certain inherent issues which we are within the sector. So how do we address that, and how do we go forward? In fact, the microfinance sector has a major role to play. We know that we have been supporting the poor people. More than 8 crore households have been supported so far, and it has to go forward. And as per the potentials estimated by several studies, we are nowhere anywhere closer to what the estimated potential is. So there is a huge way forward, and let's understand what our panelists have to suggest and how do we take it forward. Thank you so much once again, and welcome each one of you for this, and thank Access for their association. Thank you.
So I'll now request maybe Shruti to start off with the presentation, and then hand it over to Sriram sir to moderate it and take it forward in terms of the discussions.
Sure. Thank you, Sudipto, and good morning to everyone, my esteemed, panelists and all the participants who have joined. I would just like to lay the foundation with a little bit of data here, because in any, in any analysis or any insights that we throw, data is the foundation. So, given that, I've been given 10 minutes of time, so I'll be a little quick and go through some of the major pointers that have happened or, sort of shaped the microfinance industry in these last 5 quarters. So overall, if we look at the industry, and this is data as of June that we have in front of you. So June industry portfolio stands at around 3,52,963 crores. Overall, if we compare this with last year, the industry is down almost 17% today. The active loans, which is, loans up to 179 delinquency, 179 DPD, stand at around 12.53 crores. This is again a fall of around 19% overall. The April, May, June disbursement is at around 58,139 crores. The 30 plus and 90 plus delinquency, we usually calibrate up to 179 DPD. That stands at 6% and 3.64%. The 180 plus delinquency, which includes everything, including excluding closed and write-off, that stands at around 13%. So the point being, delinquency wise, we are seeing that, the December and the March delinquency sort of saw the peak in the industry, and right now we are seeing a little bit of a flattening as we are moving forward. Sectorally, NBFC MFIs continue to dominate in terms of portfolio share, disbursements, or active loans, with almost a share of 38%. Private sector banks come in next, followed by SFPs and NBFCs. So this is how, the overall microfinance industry right now in June is looking like. From here on, what we'll do is we'll look at some of the trended data as to we'll see what's happening in these last 5 quarters and what's really changed. So if we look at overall disbursements, a disbursement in terms of number as well as value has seen a huge drop from almost 8 crore odd disbursement. The industry is now witnessing around 4 crore odd disbursement. So from 3.84 lakh, the disbursements have come down to 2.6 lakh in value terms. What is happening is overall value has gone up a little bit, volume has come down significantly, because of which we are seeing an immediate muted impact in the average ticket size. So the industry average ticket size, if we compare this data with 1 year back, it has really moved up from 47,920 rupees to 53,837 rupees. In this, the NBFC segment has the highest average ticket size with almost a 65,000 rupees ATS that they are holding. Having said that, we are seeing an immediate increase in average ticket size across the board, be it NBFC MFIs, private sector banks, or small finance banks. So, we are seeing an increase across the board, and that's primarily because we are seeing a little bit of a more value based lending that's happening. And why that's happening, we will see in the subsequent slides. So what we are also doing is we are looking at how the overall 30 plus and 90 plus delinquencies have trended. Now, the black dotted line, which you are seeing, is the industry line. So if we see the delinquency sort of peaked in December 24, the industry delinquency was at its highest at 6.93%. And of course, sectorally also, we are seeing that most of the sectors peaked in December, post which, we are seeing some of the steam coming off in March as well as June. So these are some positive trends that we have started witnessing for the microfinance industry, where the delinquencies from the peak of 6.93 has now come down to 5.98%, and this is the 30 plus delinquency. Similarly, the graphs look a little bit more, sort of pointed when we start looking at 90 plus. So from 3.92%, the delinquencies now are at 3.57% by June 25. So from December to June again, we are witnessing a reduction in overall delinquencies as we are moving forward. Overall, sectorally today, we are still seeing that small finance banks and NBFC MFIs have higher delinquency compared to the industry, and so do private sector banks. The NBFC curve is really falling below the industry curve. Their delinquencies are the best right now at 2.21% as of June. So, to figure out that what is really leading to these delinquencies going up, or which are the factors which are really pushing the delinquencies upward. So we did, analysis on lag delinquencies with two different cohorts. One, we looked at ticket size cuts, and second, we looked at various lender types. So if you see the chart, and again, I'm talking of the top chart right now. The top chart is broken up into various ticket sizes of less than 30,000, 30 to 50,000. 50 to 70,000 and greater than 70,000. Now, typically, what we are trying to see is that how much did the 30 plus delinquency go up from 30 plus in 3 MOB to 30 plus in 6 MOB, and so on and so forth. So overall, when we look at this data, what we are witnessing is that less than 30,000 has the highest increase. So the ticket size has a very huge impact on how the delinquency movement is happening. Less than 30,000, we are seeing an increase in the lag delinquency, almost 3 times. 30 to 50,000 is going up 2.5 times. And as the ticket size moves up, the increase in the delinquency goes down consecutively. Also, if we do the same study and look at the sectors, and sectors are given below, that's the graph at the bottom. We are seeing that NBFCs, which is the gray bar, is managing the delinquencies much better. So the amount of delinquencies is really moving from 30 plus in 3 MOB to 30 plus in 6 MOB is relatively lower for the NBFC cohort compared to all other cohorts. Now, this also shows that, they have probably, stronger collection efficiencies at their end. Having said that, we are seeing, a trickling down effect for most of the other cohorts as we move forward. Overall, again, if you look at how the top states are performing in terms of, growth and, what's really changing for them, what you've done is you've listed the top 10 states in terms of portfolio outstanding. And overall, if we see, this on a year-on-year basis, there has been a significant reduction in terms of disbursement, as well as, the portfolio growth has gone down. Now, some of the states that I want to call out, which we are seeing very, very high rates of reduction, are the state of Karnataka, which is seeing a 43% degrowth, the state of Odisha, which is seeing a 44% rate of degrowth. Also, Jharkhand and Bihar, which are the top states, are seeing a significant amount of degrowth here in terms of disbursement. And that, of course, is flowing into the portfolio outstanding as well. In terms of 90 plus delinquencies, again, a huge change is witnessed. Karnataka, for instance, has seen a huge change of almost 9%, overall on a year-on-year basis. So that is one state which is standing out. Again, the state of Odisha and Bihar are also showing trending with higher delinquencies right now. So if we look at how these loans have aged, right? This is sort of to look at whether there have been any changes. So let's start with JFM data and let's look at the 3 MOB. Say from JFM 23, the 3 MOB. So right now what you're seeing in front of you is the 30 plus delinquencies up to 179 DPD. So in JFM, we saw that 30 plus for 3 MOBs was at around 0.32%. If we compare the same quarter of JFM 24, we see that this delinquency actually moved up to 0.45. Similarly, if we compare similar quarters in 6 MOB, say JFM 23 to JFM 24, it went up from 1.03 to 2.43, or AMJ 23 to AMJ 24, where it went up from 0.93 to 3.49. What I'm trying to say is, up until now, we used to see that the overall, vintage sourcing has only been going up, be it any quarter. The one relief that we are seeing for the microfinance industry is if you witness this particular bucket, you will see that overall, the overall delinquencies have been moving up, barring the OND 24, where, for the first time we are seeing it go down. Similarly, we are seeing a little bit of a trickle effect in the 6 MOB, where, from 3.49%, this has actually gone down to 3.03%. So we are seeing some green shoots, so to speak, in the MFI industry, where we are witnessing a lowering of delinquency for the newer sourcing happening in the current book. So this is again a very positive effect now that we are witnessing for the MFI industry, especially after seeing so many days of very high delinquency, low disbursements. If this trend continues, where hopefully the disbursements move up and delinquencies are well controlled, we will see a very positive trend for the industry. Vintage charts usually show how well, the delinquency spread out is. So, this is a little different from the previous chart of the roll rate analysis that we usually see. Now, this flagging, right? So between lines, we see there is a lot of, there is a lot of white space, so to speak, which we usually call flagging. The flagging doesn't show a good trend, but fortunately, we are seeing that flagging is coming down as we move on. So overall, vintage 60 plus, and again, over here we are looking at 60 plus, and this really, doesn't stop at 179. Vintage delinquencies show the ever information. This includes everything. So now, overall, we are seeing that the vintage delinquencies charts have started to stabilize, which again is a positive sign for the microfinance industry. The usual flagging that we were seeing previously is sort of taming down, and the lines are getting a little more in sync. So this again is a very positive trend that we are witnessing for the industry. So typical story that's coming off is that the overall microfinance industry, the kind of troubles that we're seeing data wise, it's looking like things are stabilizing quite a bit for the industry now. Now, there's a lot of discussion around how lenders affect the delinquencies. So what we have done here is we have looked at typical, one lender, two lender, three and four lender scenario, and we have plotted, how the delinquency patterns are looking. So for example, the green chart that you see, the green bar, is the zero DPD data. The blue and the rest of the delinquencies are given in terms of 1 to 29 DPD, 30 to 59 DPD, 60 to 89, and 90 to 179, which are plotted here. So typically, if we look at the one lender data, which is as of March 24, 96% of the customers had zero DPD. By December 24, even customers with one lender, 92% fell to zero DPD, 3% went to 1 to 29 DPD, and 3% were in 90 to 179 DPD. By March 25, we are seeing some stabilization in these numbers. Now, unfortunately, if we look at the same data in terms of greater than four lenders, 88% of the customers had zero DPD or they were current. 5% were 1 to 29 DPD, so on and so forth. This actually fell down to 65% by December 24, and it's further fallen down by 59% by March 25. The point I'm trying to make that, we have the SROs like Sa-Dhan coming in and telling us that the more lenders is gets a little difficult for the microfinance industry to manage. This is very much proven with data. As the number of lenders are going up, the deterioration, the amount of deterioration significantly increased. So there's a direct correlation between the lenders and the delinquency deterioration that we are witnessing today. So the point being that one and two lenders is holding very well, even three lenders to a certain point, but greater than four lenders is surely creating a lot of problems for the industry. What we've also done is we've tried to look at, with the different states and, their place coming into EMI. We are seeing whether EMI, an increase in EMI, or so to speak, an increase in leverage sort of has any play where delinquencies are going up. So we have states where, overall the change in EMI has been lower, where, there's been a 7% reduction in EMI, but delinquencies have gone up. But for most of the states, which are the states of Uttar Pradesh, Karnataka, Maharashtra, Odisha, Rajasthan, we are witnessing that as the EMI burden goes up, the delinquencies are also moving up. So the point we are trying to make is that, and of course, we are looking at very early delinquencies here, which is the 30 plus delinquencies. As we start moving on to higher delinquency rates of 90 plus, etc., these charts will become more toned out. Having said that, at EMI, delinquency has a direct impact, which is also showing the current leverage situation that the industry is facing. So the point we are trying to make is that the EMI burden today, which the customers are bearing in some of the states which have a very high delinquency rates, need to be looked at by the lender as well as the SRO community. So that's some high-level data points that we wanted to show from Equifax. I will hand it over again to my esteemed colleagues here. Thank you.
Thanks a lot, Shruti. That was very useful. I think we got a good understanding of how things are moving. Very clearly, you seem to indicate that the worst is over. We are sort of stabilizing, moving upwards, though limping towards stabilization and moving upwards. What I would like to do is I'd sort of go back to Vivek first. To get his perspective both on the data and what he's seeing on the field, then followed by Sadaf, and then we could get Mr. Vishwanathan. I would also come in a little bit, and then we can open things up for one round of discussion within the panel, and possibly if there are any questions from the audience in the chat box, we'll take that up. Vivek, over to you.
Good morning. Good morning, sir. Good evening. Good morning, everybody. I think the industry has witnessed positive resilience after COVID, and that has impacted in a different way, because after COVID, this was the industry. During the COVID, we were assumed that this industry will not be able to survive, and because it was more touch based and center meetings were there, and it was more personal relationship type industry was there, and we were able to come back during COVID time, even after having a lockdown of 3 to 6 months in several markets. So that was the strength of the model. That has may have given comfort to many other lenders to jump in the market at the same time. And from 2022 to 2024, we have seen number of type of lenders. It is not only the NBFC MFIs, it was different type of BC players and of NBFCs and banks, and also even the unregulated and pseudo-regulated entities, they were operating in the similar markets. From my ground visits, I can say that there are the several districts where 125 type of 125 micro lenders are there in the market. This market was almost, we created this model especially 25, 30 years before, just to serve the underserved market and where no one was reaching. And especially the microfinance processes were there so strengthened that we were able to identify the real needy person who is willing to have an enterprise, who is willing to create something for his family, who want to come out of poverty, or who want to who want to stabilize his life cycle needs and gradually to come back to the mainstream. But EG credit in 2022 to 2024, I think that has disrupted the market, and it is because of many type of players were active in that particular market. The Aadhaar, I think the verdict from Aadhaar, it has also played a very important role. Earlier, the data of Aadhaar was being captured with the credit bureaus, and when we were pulling the bureau reports, it was the uniqueness of clients were ensured from, I think, 2017-18 to 2022, it was there. But after the Supreme Court verdict, the Aadhaar was, the credit bureaus were not allowed to store the Aadhaar. They were working on, the bureaus were working on certain assumptions, and in many cases where the actual delinquency was not explored by many players on the ground. Someone has done a good job, but someone has not done good job. It is just the challenge. One place, my branch manager may have not worked very well. Another place, someone else. But everything was, the indebtedness was being captured by the credit bureaus, and that analysis was there. We have failed in analyzing the actual overt indebtedness of a particular family or particular customer, and gradually the competition to grow in that particular market, because it was one of the best performing market post COVID, and which was just 1 year before it was assumed that it will not be able to survive. I think it has disrupted the market, but this market has lots of potential. Our 8 crore customers is scattered in all across the country. They are our biggest asset. Even in this difficult time, when media was reporting almost every day something negative for the sector, we are having almost 8 crore customers. Some 15 crore transactions are there every month with these customers, either bi-weekly, monthly, and weekly. There is the interaction and transaction with these customers, and it is around a huge transaction is happening in the with these families, almost 15 crore plus transactions every month. That is something means huge, and it is just like a country means 15 crore is a huge population. If you are dealing with the individuals, sometimes someone may be happy, someone may not be happy. More than 3 lakh employees are active from the microfinance sector, especially on the ground. You cannot have control the behavior of everyone in a very specific and trained way, but every institution has put their own responsibility to control that. But this 8 crore customers data, that is the biggest asset. The employees are the biggest assets of this sector. Means those who have created this sector, those who have served the sector even during the COVID time when the restrictions were there. We all have lost good number of employees during the COVID time, especially during the wave 2. And even it was difficult to control the team, to work, to ask them to work during difficult time. That has been passed, but all these things are part of the model. The lending pattern was very easy. Means it was never, just 4 years before, it was never so easy. Even during the COVID time, we were having the metrics, controls, and data centers, and they were analyzed, but that has impacted. But every problem has a peak, and now we have touched the peak. I think in the month of December, we have seen the some declining trend in the month of March, but impact may be visible in the balance sheets in a quarter or two, but on the ground the things are being stabilized now. And the opportunistic players, means those who were just playing in the market for just seeing some profitability, some growth, some creating the network, or some utilization of network for other purposes, they are slowing down gradually. The serious players, they will be active on the ground. From 125 to 30 lenders, I think every district has a capacity to easily manage 25 to 30, and we can, if we can rationalize. One place is we are rationalizing through the number of exposures per customer. That is one. But on the other side, if some way we can restrict number of lenders in a particular geography, because still there are good number of districts where no one is present. Entire microfinance concentration is limited to just 200 districts of the country. As of now, there are almost 700 districts are there. Almost 500 districts are there where limited players are present. We have to diversify in these directions, and the reach what we have created till now. Earlier, it was everyone was going in the same geography where the microfinance culture was there, because we were restricted by to operate in a 10% margin class, and everyone wanted to reduce the operating cost, and that has thus has pressurized everyone to do not create any new geography, but move in the existing geographies only where someone is present. And after the deregulations, I think more players have emerged in these markets only. That has impacted. But uh, even every day a negative report about the sector, every day something unauthorized players, they have been moving from one part to another part for the loan waiver schemes, and all these things were happening. But 80% plus customers are resilient with the sector. They are paying everybody in the sector without a single day delinquency, even in current time. That is the biggest asset. The other thing from the Sruti's data, it was visible that the loan amount of up to 30,000, that is more delinquent. It means that is the consumption loan. That is the area where the more stress is there. These loans are being either least utilized, or they are additional loans or top-up loans, or they are some additional support loans may be there, but they may be having some stress. But overall customers, where they are utilizing it properly, where the financial literacy is there, where we are sitting with the customers and villagers in a proper way, I think we are able to bring back them in the normal cycle gradually. And I'm optimistic that this sector will be able to bounce back very fast. This sector needs innovations. This sector definitely needs to utilize its potential in much better way, and the benefit must be passed to the poor. The interest rate is one part, means that should be, means gradually, either from your borrowing side you can because it is priority sector lending, we can negotiate with the banks and government to have a cheaper funds for the sector. That is one part. On the other side, the operating cost can be tweaked in such way that it is not so high, and risk part can be balanced. All these things are a combination, but people in India, they need money. If we are not able to support them in this particular time, I think definitely there may be a difficult issue, especially in the rural India. Rural will be in the distress in coming 2-3 quarters, and that will be difficult to manage. Microfinance is the only way which is supporting the ground in a more effective way, in a more resilient way, and in a respectable way. That is the way. But this sector needs more digitization. This sector needs more AI intervention, more data analytics, more process controls, and in the areas where the more lenders are coming in that particular area, nature and behavior of these lenders, that is important. How all these things can be guided from the SROs, that is also a critical role for all of us. And NBFC, MFIs plus lenders, they are also, earlier they were thinking that it is just a lending and collection business, but it is more about culture business, connect business, and discipline business. We all are in the same boat, and we need to think together to build a resilient model where the Indian people at the base of pyramid, they are having the enough supply for the funds. It cannot be every time secured loan, it cannot be gold loan, it cannot substitute anything else. Microfinance beautiful model cannot be replaced by any other model, but with more responsibility, more care, and more education, more transparency, I think things can go in a better way. And I'm very much optimistic that microfinance in the coming years will be more positive, more purpose serving, and more I think it will be building, it will be helpful in building the nation.
Thank you. Thanks a lot, Vivek. Sadaf, Vivek has given a perspective of his experiences going through the COVID crisis and later, and has indicated there is optimism and the model cannot be replaced. It is unique and it is innovative. In your presentation, if you could look at what are the possibilities for future and what are the possibilities of innovation that would sort of add rather than get back to your own experience, because I think the experiences would be similar and common. So if you can do a little bit of crystal gazing in terms of what is there, that would possibly help. You also can locate it in the larger economy, growth, inflation, and what's happening. Because microfinance is not a standalone activity; it is a integral part of the larger economy. Yeah, thanks. Thanks, Vivek.
Thanks, Sriram. Good morning, everyone. Thank you for this opportunity. I think, first of all, let me congratulate Shruti on a wonderful presentation on the data that she had shown. It reveals quite a bit of stuff which I'll also talk about. And I also entirely agree with what Vivek ji said. One thing that I would want to kind of highlight and underline is that this is a very resilient model. We have seen multiple crises. We have seen Andhra crisis, out of which the policy of diversification of portfolio came out. Post that, we saw a demonetization crisis. After that, we have seen complete digitization of disbursement came out. We have seen COVID crisis, out of which a digital collection also came out. It has not reached 100% level, but I think there are companies who are collecting 50%, 30%, 40% in digital format. So I'm very sure that this crisis will also come out with some innovation, and we'll be able to tweak the model in a manner that it will serve the clients, it will serve the organization who's running and people who are behind it, and of course the sector. The most important thing from a resilience point of view, I would say, and what Vivek ji also highlight is the 80% or more than 80% borrowers who have continued to pay even in difficult time. And we have seen that during COVID crisis also, when there was complete lockdown, still people came back and paid a lot of money. So which shows that this borrower is trustworthy, this borrower is credit worthy. That's the fundamental principle here. Of course, every situation has causes. I have a theory that the current situation is a mixture of three, four things which have happened. One is, of course, as Vivek ji said, post-COVID, there was a lot of lending which happened. Of course, there was need for credit also to establish new jobs, new work. So a lot of money flown in from all sorts of sectors, NBFC, MFI, banks, private sector players, and other entities who were lending in this segment. This led to, of course, increase in credit exposure for the borrower. But at the same time, I think this sector, howsoever small it is in the larger context of the economy, it can't stay away from the realities of the economy. The reality of the economy is that the rural wages have not grown as much as the credit has grown. So the burden on the borrower increased because they borrowed more, but their income did not grow. At the same time, they were hit by another thing, which is inflation, and particularly food inflation. Because in like urban borrower and rural borrower, the key difference is that any sort of a food inflation hits the borrower a lot more, because if it's an inflation in consumable items like a fuel price or something, or like an urban borrower will decide, okay, I would not spend so much on my entertainment, or I would not go for a movie twice in a month, I'll just go once, so I'll conserve money. But a borrower at a poor household, and when the inflation is food inflation, they don't have any choices, they can't skip meals. So what they do is they deprioritize other expenses. And in other expenses, what comes first is maybe an unsecured lending, because a secured lending, they need a roof on their head. If they pledge their gold, they don't want that asset to get auctioned. So what they do is they deprioritize the unsecured lending which is there. In this case, microfinance faced it. But then again, I would again reiterate that 80% of the borrower, more than 80% of the borrower, still continued to pay everybody on that time. And Shruti's presentation shows that people who had unique kind of trade line, almost 92% continue to pay on time, which is, I think, very, very healthy kind of indication of the credit behavior of this borrower. At the same time, I think there were issues like Karnataka issue which came in, which had an impact on the portfolio of MFIs. While there was an excess of lending, which shows in the presentation also that EMI exposure for those borrowers in Karnataka particularly increased almost 45%, and that led to overburdening. So we can't really ignore that there was nothing which was wrong from the sector also, in a sense that what Vivek ji said is that we need to diversify it in deeper geographies. And that, in my sense, has to some way incentivized in a manner that just like if we have prompt repayment in a BC model, there is an excess interest spread which is given. Similarly, in areas which are less kind of penetrated, there should be some leeway given to MFI to operate at a higher kind of a rate so that they can compensate for the cost that is there. One of the things that came out in this crisis also, that sector showed resilience, and most of the NBFC MFIs are very well capitalized. If you look at the top 10 or top 15, they are all having more than adequate capital. So the era of mere bare capital, which is 15%, is gone. Most of the entities are backed by large corporates, large investors, and they manage good capital adequacy, which reflects good governance and stable balance sheet for the sector. That's another thing. Coming back to, I think, your question in terms of how the model will change. In my assessment, we are in a transition phase. There was a need for microfinance because there was a challenge of excess. Most of these borrowers did not have access to credit, even though some of them may have some sort of a bank account, but they did not have any way to get credit. So microfinance was a very good vehicle to reach out to these customers, and successfully for last 2-3 decades, it has delivered. But credit to Jan-Dhan, Aadhaar, and mobile penetration, I think the JAM Trinity has solved the access problem for large part of the population. So today, a bank also can reach to these borrower through the Jan-Dhan Aadhaar model and have a BC and provide credit to these consumers. So I think to an excess problem is solved. Now the problem is whether we can give the right product to the right customer. Because once the excess is solved, the customer has multiple choices. And she would, of course, be tempted to take one or two or more loans. How do you ensure that you are giving a right amount to the customers and to the right customer? So there is a credit underwriting model that needs to evolve. I think no longer one size fit all kind of policy will work, that you give all the borrowers the same amount and based on joint liability, they will continue to repay. And now and going forward, it has to be based on individual cash flow assessment of the borrower, what she is doing, what is the purpose of the loan, and whether she has the repayment capacity and repayment capability or not. I think that is very, very important. Globally, we have seen individual loans in Africa and Latin America have worked really well, and once the model evolves, it moves towards that direction. But I'm not saying that today we are at a stage where everything will move into individual loan. I think it will be a combination of both. Some part of it would be still joint liability group. Maybe the newer markets are still not very mature market, but certain markets, especially like Tamil Nadu, Kerala, Karnataka, which has evolved and people have been taking microfinance loan for 7, 8, 10 years, they will move into higher category, which may be individual loan format. I think that is one thing. Also, I would like to help kind of enlighten everybody here that microfinance has also helped these borrowers create assets. And maybe Vivek sir can resonate with this. Earlier, when we used to go to a rural household, we hardly found any sort of assets like any white goods there. We would only see some utensils, something like that. But today, if you go in this household, everybody would have some sort of a small fridge, some gas stove. I think social benefits from the government and also some bit of microfinance intervention has helped these customers create assets. In most of the states, there is a finance available for building a pakka house. Some of these borrowers have also made with that capital a pakka house. So there is a possibility to provide right amount of credit to these borrowers with some sort of a collateral so that overall burden on these household is not increased unnecessarily, and the lending is done in a safe manner. That is also a possibility. If you look globally, And if you look at internationally, the definition of microfinance is not limited to unsecured lending. It is across the board in terms of whether it's collateralized by gold, whether it is collateral by house or any other collateral inventory stock. As long as a certain ticket size is served, it is called microfinance. I think that is what Indian model needs to evolve into. Define microfinance by the loan amount that we are offering rather than the customer segment that we are offering, and also look at hybrid of joint liability as well as individual loan model.
Thank you, sir. Vipin, you have a point to make?
Yeah. Raise your hand, I think.
Pardon me?
You have raised your hand, so.
I think that must be a mistake. Okay. Since Vipin is not responding, let's come back to you, Vishwanathan. So,
Okay.
I mean, I know that you're no longer a regulator, but we always put the regulator hat on you, whether you like it or not.
Yes.
So, please tell us, how do you see this new, qualifying asset change? And would that take the focus away from inclusive finance? I mean, I'm sure that move is certainly welcome and helpful for the microfinance institutions to clean up their balance sheet and keep the balance sheet better. But what happens to the agenda? That's one. And is the regulatory architecture, given that even the SFB priority sector lending requirements are also down to 60%, is the regulatory architecture looking at this from a different lens? What is, I know you're not an insider. How do you read it as an outsider?
Whether you like it or not, I'm still a dyed in the wood regulator. So I'll keep it that way. I think three important trends I want to mention. And, one good thing is that the presentation kind of put things in perspective. And both the sector representatives are very positive and gung-ho about the sector. So that's a good beginning in a way. I see three important trends, in terms of what Reserve Bank is doing. One comes from the need for harmonization. So I think even when I was in the Reserve Bank, there was this issue that there are banks which are lending, they don't have any of the constraints. So they kind of capture our potential market, and it's leading to problems for them, and their own borrowers are getting in trouble. So to that extent, since I think Sahab mentioned this, that banks are also entering this fray thanks to digital ability to connect with the people and through the BCs. So because of that, if you do not have an uniform and harmonized approach to definition of microfinance loans, you will have a problem. So I think that way it's a good measure to bring that harmonization, number one. Number two is, when the Reserve Bank also gives a lot of autonomy, right? Except for the 3 lakh and family income per annum and saying that it's an unsecured loan. There wasn't any other definition of what is a qualifying asset. That's what it's moved to. What it means is that autonomy should come with responsibility. I think I'm very happy both Mr. Vivek and Sadab mentioned that. And, in fact, I think MFIN came out with the regulation that there should not be more than 3 lenders. Otherwise, they were going. So I think responsibility on the part of the players is very important. Third, if you ask me what's driving the regulator, I'll put it this way, that in an economy of our type, I think there are both aspects to be balanced. One, the socioeconomic objective on the one hand, and also the need for banks to be able to be commercially running in a manner that is profitable. So I think it's a very clear understanding that while on the one hand, microfinance does serve an overall socioeconomic objective, that socioeconomic objective will not be achieved if that is not being done in a profitable manner. There is a limit to such activities being conducted through a philanthropic approach, like funds which are not for profit kind of funds. And the fact that Reserve Bank said those which are above 100 crores, which are Section 8 companies, will also be regulated like any other, also very clearly shows that there is that much that not-for-profit entity does, when it comes to this activity. So I think the reduction in priority sector lending for SFBs also comes in that, but in a way, it paves the market for MFIs, right? So to the extent that the SFBs will try to reach to this, achieve their private sector lending through MFI type of exposure, to the extent they recede, that much more space will come for the MFIs which are specializing in this area. But I agree with you, it's a balance to be made. Are we missing the focus? I had my own personal experience, which I can tell you. For example, this is particularly a problem which arose when the income limit was 1 lakh per annum. And there are relatively richer districts and states in the country. Okay, I can specifically mention the Punjab. So the MFIs which are serving that state and the related states came and told me, I do not have a borrower with an income of less than 1 lakh. And similarly, I feel that as the economy grows, the definition of income level of a microfinance borrower also should keep going. Otherwise, you will the bottom of the pyramid keeps on going up in that sense. And it's a good thing to happen, right? So I think overall, I would say that the approach of RBI comes from the need to harmonize. Say that there are multiple players who are doing the same thing, but under a different regulatory architecture. And unless that is brought into a simplified and single framework, it is difficult to regulate it properly. Number one. Second issue that I see, and I think that's kind of coming out from Shruti's presentation, is that there's a relatively higher delinquency in the lower loans, and that's I think something that struck to me is that you have a FOIR of 50%, right? That's what I think RBI has prescribed. But for a person who has a lower income, the residual 50% may be much smaller. So I think my view was that RBI has put a maximum. Okay, there must be some way for the NBFCs to ensure that their residual income for the person after paying the obligations are also reasonably manageable. So I think this is one important, because if everybody applies 40, so the 50,000 guys will have a balance of 25, 30,000 will have a balance of 15,000. I'm talking of income. I think so. I think this is an important element that we must work on. Fourth, of course, there has been, wherever there's been crisis, I mean, every crisis, the secular space, apart from some of the external, which I do agree, are coming from excesses by the NBFCs themselves. And I think whether you look at Andhra, whether you look at what's happening in Karnataka, they're also coming from that part of the behavior pattern of the MFIs, and that's something that they need to, kind of manage. And it must be very clearly known to them that there are other players, I mean, who are not regulated. And so it's something like, am I knowing and still closing my eyes because I want to grow my book? Or, then it has its own accidents, outcomes that are possible. So I think being a lot more aware of this, and regulators and RBI are trying to work on those, what you call unregulated apps. They've been taking down a lot of apps that are coming up, but those players are still there. You just can't help it. And last point that I want to mention is that now of course there is this 40% freedom. I mean, it's become 60-40, and at the same time there's another element that's happening. So one is 60-40 brings you the need for MFI type of loans. Qualifying less has become 60, but it has also allowed non-MFI entities to lend from 15 to 25%. They have increased that as well. So there is a competition. And on the other hand, you have a smaller amount to meet your target. So I think all these things will have an interplay. Last is the whole, I think there was this mention, right, about what do you call the data, credit information being not linked to Aadhaar. Deduping is required. And again, my worry, pardon me for saying this, I'm still having the regulator, like it or not. I don't think it's just that deduping is all the issue. So there are MFIs which believe, okay, I know this guy is auto borrowing in another name, but mera balance should be badhana hai. I think so. My view is let's be very clear. This is an important activity, and this will continue. Only thing is the definition of who is a microfinance borrower should keep on evolving, so that more and more people who are. So as the economy grows, the lower bottom size also will become, the minimum income of the lower income group will also go up, and they must keep on being served. Another point of view, there was this, I think in one of the introductions to one of the papers I saw, this whole issue of some of the legislative changes that, like Karnataka having brought an ordinance or law, and I think Tamil Nadu has brought an ordinance in the process. We must make very clear that one, technically, the law is has been stated in unambiguous terms by the Supreme Court, saying that entities regulated by the Reserve Bank cannot be regulated by the state government. That's very clear. Okay, I do agree that some of these laws will have an kind of a spillover effect on the behavior of your own borrowers. I'm not saying that. That is where I think the need to educate, train. See, it's very easy to raise our hands, right? So I think it's important to educate the borrowers, educate our own employees on the implications of some of these laws. And I think in actuality, both Karnataka and the Tamil Nadu ordinances are very toothless when it comes to what they can do to the NBFC, MFIs or that. And it's something, again, worth studying. Maybe, somebody, Gigi or Vipin, we can think of is why technically whoever is not covered by the RBI and NBFC regulation, at best they are covered by Moneylenders Act. Okay. So what is it that the states are trying to do by not enforcing Moneylender Act and trying to create another legislative framework which actually does not do anything to this sector, except it is maybe, kind of a political posturing, or maybe it's creating some kind of an ambience or environment for non-repayment. So I think these are things that as both Sa-Dhan and Sa-Dhan will have entities of both kind. Okay, so you will have to look at, so how to handle this both at the entity level, at the organization level, and with the government level, I think is what I think we want to mention at this stage.
Thank you, Vishwanathan. I will, stemming from this, I'll ask a question to Vivek before I get into the audience question. Vivek, you said that in multiple districts there are 25 to 30 players, and we can still take that sort of a participation of 25 to 30 players. And you said that less penetrated district, there are lesser players, and this is all about access. Now, if there are 25 to 30 players, then we can assume that there is competition. If there is competition, how has it resulted in our product offering being different from any other entity? For instance, when I go to the field, I get the sense that there are MFIs and there are SHGs, generic, and customers are unable to distinguish between a Satya, a Fusion, a Muthoot, Annapurna, or any of these things. So what does competition mean actually for players like you? And how does it manifest itself in terms of the services offered to the customer, the pricing, and so
on? For the customers, the availability of money at their required time, I think as per when they require the money, if someone is able to serve that purpose on that day, that is important. Earlier, there was a continuous group CGT was there that was for 5 to 7 days. It was a process of understanding customer and company both. And that has been diluted in last 4-5 years, because at one point of time the market was matured, and then whatever was the training that was known to many customers in the families and everyone. But gradually, when too much players are there, someone is following the training process for 5 days or 3 days or 7 days, there may be one player who is in that particular market, and they can agree that even 1 day training is more than enough, and whatever is required, I can train at my branch, and that process is completed in a single day. That may have encouraged others to cut short the training process from 5 days to 3 days to 1 day, and even to 1 hour or 2 hours. I think that was the something the traditional players, they were pushing hard for the longer trainings. But the more commercial players, for them, the training was not too much important, because for them it is just sharing the terms and conditions of the loans, and loans are given to them. That was one part. The other part, when it comes to differentiation, how we treat to our customers, the respect, the way, and even in the center meetings, how we sit on the floor, or on the mat or something, means that is important. Some players, they call the customers to the branches for the disbursement. Some, they go to their home houses for the disbursements. The transaction cost is there. If some customer is coming from 30-40 kilometer village to a particular branch, it has a transaction cost of almost 500 rupees on that particular day. But if someone is doing it in the village, it has reduced the cost. All these things are sometimes, it does not are covered in the cost, or in the training, or in the understanding of a customer, but they impact. But how you are able to educate your customers from one level to another level? In my understanding, microfinance traditional model is just a nursery for the financial inclusion. And what we have failed in last several years is how we need to upgrade our good customers from one level to next level, and then we can offer the better products in combination with the banks or other financial institutions who are authorized to do that. That synergy we have missed in last 10-12 years, and this is a time where we need to develop that. Every customer, as Sadaf Saab has told, that they don't need similar type of product. We have noticed that they are borrowing from 4 or 5 institutions. It means, and they are paying to everybody. It means their requirement is up to 2 lakh rupees, or 1.5 lakh rupees, or even 2.5 lakh rupees. May need a tenure of 3 years, may need a tenure of 4 years, or they need a continuous cash flow in their businesses. If they have set up business today, it may require another loan after 6 months. And the similar entity, if they cannot offer, they go to another lender. All these things need to be discussed and need to be harmonized, because the basic customers, they are having the intent to pay. Even the delinquent customers, those who have not paid in last 1 year, even they have started paying. That is something very positive happening on the ground. So this needs to be harmonized, and I am very optimistic on that. So you are mute.
You're on mute.
Yeah. Thanks a lot. I don't think I got a very clear answer on the differentiation part, apart from distance and how you treat the customers, product offering. But I'll
Digitization
come
may
back
be
to.
the
I'll come
next
back
one,
to.
sir.
Hang on. I'll
Digitization
come
may
back
be
to.
the next one, sir. Digitization may be the next one, where the mature customers, they can apply the loans online. They can be served in a different way, and they are
Yeah.
not required to come in the
Vivek,
center meetings in the
Vivek,
city.
all these solutions are generic solutions, which are not brand-related solutions. That is the only point that I was trying
That
to
is
make.
true. That is true.
Right? So,
Yeah.
I mean, this is something that anybody can replicate if one
Yeah.
entity replicates. So that's the point that I was trying to make. So for the customer experience, there's no difference. That is a minimal point that I was making. So let me come back to you. Two things. One is, of course, if you would like to pick up this question, that is fine. Along with that, you sort of talked about access to finance. Do you get a sense that the level of access, I mean, of course, there is always new to credit customers and so on, but mota, on broad terms, have we cracked the access problem? And therefore, the number of new to credit customers are tapering off. I mean, and existing customers, are we deepening the engagement? And is this access now turning out to be excess? Uh,
Oh,
so,
very good question. I think that's a valid point that you make. I think, firstly, one point that I would like to make in all of this conversation we are missing out is one very critical element, that is our employee. I think when there are 25 people operating in one district or one state, the biggest chase for, apart from the customer, happens for the trained employee. And when you have these employees jumping ship from one to another, then of course it leaves behind a hole at the other entity. And with the lately kind of gig economy and the kind of workforce we are getting into the gig economy, has also led to people being, I would say, for lack of a better word, less loyal. So they feel that, okay, microfinance as a job, if I don't like, I'll just go to another gig job and I'll just switch on my phone, use that and work there. That has also played out in Not so much in credit behavior of the customer, but definitely in the repayment pattern, because it's difficult to replace those resources immediately. That plays out. I think coming back to your question, in terms of how we can make it unique and attractive for the customer. I think the idea, as Vishwanathan sir mentioned, that was to create competition and make sure that the services for the borrower improves. I think from that perspective, once the entity reaches certain scale, there is a need of innovation in services. So today, microfinance does not only offer microfinance as a loan, a joint liability loan. There are other services also. There is insurance which is passed on. There is healthcare services which are passed on. And I know for a fact that Vivek sir's organization also runs e-clinic for the borrowers, and where they can come and get medical treatment. So these are all kind of services which engages the customer, which may be customer may prioritize one organization over the other. Ultimately, we are into services business. The better the services, the more the customer will prioritize us, and more he will pay or she will pay honestly with us. But I must say, I think I heard Vishwanathan sir say that in this segment, profit is also important. I think that is a very great term. I think this webinar is already a hit and success for me, because coming that from a regulator is very, very important, a former regulator. And because ultimately, whether I'm in any business, philanthropy can work to a certain extent, but beyond that, in a sustainable manner, in a regular manner, it has to be a bottom line driven business. And that would only be possible if there is a sustainable pricing which is done. And I can give you an example. We talk about excess in terms of pricing, usurious pricing or something. We talked about this. I think if you look at a 50,000 rupee loan for 24 months, priced at 22%, the weekly installment is 599 rupees. If you price it at 23%, the installment is 604 rupees 77 paisa, 605 you can say. And if you price at 24 rupees, it's 610 rupees for a weekly installment. So there is a difference of 5 rupees. I don't think so. The borrower really is concerned about whether I'm paying 5 rupees more or not. And I don't think so that will create so much a burden that she will start defaulting. But definitely, whether I'm able to get her that installment, and as Vivek sir said, on time that loan I'm able to get her or not, that is very, very important for her. If I'm able to give her a loan at right time when she needs it, she will prefer me, and she knows that in future I will also get a loan from this entity. She will prefer me. And I also want to use this forum to underline the fact what we are providing is a working capital loan. We may call it's packaged as a term loan, but ultimately it's a working capital loan for a rural household. The moment you pull out that capital, of course there would be default. And that is the reason you saw in the data the disbursements have gone down by 30%. And if you pull that 30% out of the system, of course, there will be cash crunch at the household and there would be defaults. I think that is one reason. It is important that we continue to lend and ensure that I think that excess does not become access. And financial inclusion, as you said, I don't see that we have reached as in complete. The excess has been created, but financial inclusion means credit, it means insurance, it means remittance, it means savings, it means financial literacy. I think we need to complete the whole circle. And there is no better way, as Vivek ji also said, and I also would say, that microfinance is one business which has reached to the hinterland of India, made a connect with the borrower, and this can be better utilized for creating awareness. And with the economy going digital, it is even more important to create awareness and educate the borrower. I feel particularly proud when I deal with a customer and help her do her first digital transaction. We started this business when we used to help the borrower sign for the first time, and she used to feel empowered. And imagine the empowerment she feels when she is able to do digital transaction. I think this whole ecosystem has to be used more beneficially for the economy. I think microfinance has a big role to play.
Thank you. Thank you. Vishwanathan, you had put your hand up.
Yeah. Uh, two quick comments. One, I forgot to react to Sadav's observation on incentivization for reaching the unbanked or uncovered areas. So that's one thing we must look at. Now, how do you do it? I mean, whether it's regulator, whether it is the body, the associations, how they will work in the direction one we have to look at. I mean, I think, for example, today RBI has understood that regional imbalance is an important element to address, which is why they're given different weightages for loans in less banked areas, right? All those things have happened in the priority sector. So we have to talk to regulator and see if there is a way, or is there something that internally you yourself can do. One kind of way to look at it is whether you will have freedom to have different interest rates. Okay, I mean, RBI is fixed, and I think RBI, if you look at the regulations, even the latest one, RBI says it should not be usurious. They have not defined usurious. Okay, it's left to you. But for me, I think what is problematic is transparency. If there is no transparency in how the interest rate is told to the borrower, with their hidden costs, okay, that is what I think will be more worrying for the regulator than nothing. Third, an innovation I thought is, look at why a person goes to money lender. They know he is an unscrupulous person. He has very hard ways of recovering, but they would choose a money lender over a regulated financial entity. I know as a regulated financial entity, there are limitations as to how far we can, reduce our procedures. But I think what we must all look at is how much can we ape the money lender's way of doing things within the larger regulatory framework, except the hard, recovery process. Okay, so in the lending process, is there a way that we can simplify? He must feel almost the same as getting money from the regulator as he can get from the labor front. So what we can do and close that gap is, I think, what we must all work on. Last, and it's not a clarification, I'm being very clear. There's no lack of clarity in RBI that you need investments to bring microfinance up to speed, and investments will come only if there is a reasonable return on equity, and that's something that. But what would be worried is if the return on equity of a very high order drives the way the entity conducts its business. I think this is what should be. So it's a balance again between. So there's no quarrel, and I think what RBI is doing is also very clear that yes, this business is required. This business requires investment. You can't get investment which is not profitable. But anything in excess, is a problem. So I think it's more the entities being more responsible in the freedom that they have got in how they run the business.
Thank you. I'll take the audience questions. Audience questions are getting posted on the chat. Since I have not spoken and I only ask questions, I'll take up a question which I think I can answer and then pose the rest of the questions to you. This is a question by Indrajit Kumar, which is the last question. So I'm sorry, I'm jumping the queue. Can we consider the present scenario as cyclical trough for microfinance, or is there a deeper structural correction yet to unfold? In my opinion, this particular crisis is not like any other crisis that happened before. Any other crisis would be cyclical. This possibly is not. My reading of the data seems to indicate that essentially because the access problem we seem to have cracked in large parts of the country. I'm talking of, in general terms. Obviously I could be contradicted by one instance from Kerala or one instance from Manipur or something like that. I'm not looking at that. I'm saying that in general, we have cracked the problem of access. People have started dealing with this loans over the last 20-25 years. And there is, if we were to look at the entire microfinance customer base, not every one of them are willing to take that leap forward for a next level of investment, because that requires much more risk appetite and much more of investment, and that's a different model. And therefore, this segment is in a way saturated and can maintain. And that's what is the sense that I'm getting when Sadaf says or Vivek says that 80% of our customers are doing well. So obviously 80% of the customers are maintaining, and they are maintaining at a lower portfolio exposure of all the microfinance sector. If you press the pedal now, will this thing be the same? That is the question. So that also weaves into the activity. I mean, the point that Sadaf made, that wages have not increased, there is inflation, and the overall economic growth is not seen. So therefore, I think this is not a typical cyclical thing, unless, I mean, you can still say it is a cyclical thing, that if the economy becomes very buoyant, this will also become buoyant. But I think in terms of penetration, microfinance has done significant amount of penetration, and it needs to pause now and use this 40% opportunity to look at the same clients and say which of these clients can upgrade. If we are looking at which of these clients can upgrade, that model has to be completely different, where you actually engage with the client. That possibly answers Suran's question, which he asks, why are assessments done purely based on credit bureau data only, and there are no field studies? I think the moment we move, then we can't be laid back with credit bureau data. We need to, actually our customer services agent or our field officers know what the customers are, but they have no mechanism to upload their understanding, which is subjective understanding, onto the databases of the systems of the this thing. Second, our credit officers are also much more of extension fellows and not credit fellows. I mean, they're good at mobilizing people, that are possibly not very good at this thing. So the MFIs need to really rethink on their model. I'll stop with my observation and get on to the next important. This is an interesting question. I think Shruti, would you like to take it? He's trying to hold you responsible. That is contradictory, where one side data is saying less delinquencies with ticket size going up, and the other side EMI. I think that's an easy one. Please sort that out, and then we'll move
That's
on.
an easy and a very interesting question, actually. And, the data throws a very interesting analysis. And this goes back to what probably Vishwanathan sir was saying, that, we are finding that while certain customers, have the same income level, but overall we are seeing income levels, going up. So what data is throwing out is that when let's take two customers, A and B. So say A gets a loan of say 50,000, and then A is up to say 1 lakh rupees, and then 1,50,000 rupees. His delinquency levels are, or her delinquency levels are better managed compared to B, who's been given say 30, 30, 30, 30 by different lenders. So what I'm trying to say is that if the number of lenders go up for the same value of the loan, the delinquency is higher. But if there is just one or two lenders, and the say it's both are at 1,50,000, then that delinquency of A is lower. So somehow data is throwing that trend. And I think the answer was also given by Sadaf sir and Vivek sir to a certain extent, that where they said that we tend to look at, when we give a higher ticket size loan to a certain lender, to a certain customer, we evaluate that customer with much more depth. Probably that is the answer. But data is surely showing this trend where, the number of lenders is affecting the delinquency behavior. Yeah.
I'll take the next question. Possibly, Vivek, you could answer this. This is a question from Misha Sharma from Dwara, who says that with the customers who have been with the MFIs for 8 to 10 years, is it possible to think of ways in which interest rates on loan could be reduced, assuming that she's a digital customer, and possibly the cost for dealing with that customer is much lesser than an NTC or NBFC customer?
Definitely, digital lending may play a very good role to identify good customers, but we are not aware about exact risk that will come when we are having a digital onboarding. To understand a model better, to understand the risk better, it may take some time, but I think digital is the way where the operating cost can be reduced gradually, but not in immediate term, means it is just because every digital lender, they are charging different rate because the risk is very high.
No, the question, Vivek, is not about digital lending. It's more about a customer who has a vintage with the organization. Can that customer who's used to your systems, can that customer be graduated into digital transactions, not digital lending, digital transactions, and therefore could the interest rate for vintage customers be reduced? I think that's the question.
Definitely that potential is there. I think the within the customer segment, those who are 7 to 8 years old with us, we need to focus on the digital literacy of that customers, more awareness of that customers. Means they are having the 10 cycles with us. It means their age may be in the range of 40, 45. In that particular age group, the literacy level, especially digital literacy level may be comparatively lower. We need to focus on that.
Sure.
But if that is adequate, I think the cost can be managed and that can be reduced.
That's an interesting answer. Vishwanathan, I'll take this to you because this is coming back to the qualifying assets norm.
Yes.
The question is from an anonymous attendee.
I saw that, yeah.
We should still take an anonymous question. I don't think
Yes.
there's any controversy here. Can you just answer that? Is it diverting from the main objective if you reduce the qualifying assets to 60%?
So, I mean, it's too difficult to say. I mean, it's also a question of what you call. You also mentioned, right? There are some places where there's a kind of saturation. So it's also understanding how to one base for RBI is nothing doing, which will end up the NBFCs, maybe the MFI is not meeting the target or going for wrong selection of borrower, which is again bad, right? So I think for me, the RBI has always been telling that in the past, access is more important, cost is not. So today, access seems to, I mean, there are pockets, as you know, which is not there. Access seems to have been, to an extent, large extent, addressed. So maybe instead of at one stroke raising the income level and then bringing in possibly borrowers who are not yet eligible to be MFI borrowers, it's better to allow the MFIs to lend to the other segment. I think that's the only way I can explain. So, and it's also it's too early to also say this is possible. It's a 60-40. I don't think overnight it's going to become 60-40 either. So I think we must wait and watch. The jury is definitely still not out. And whether this itself is going to be a sign that, the microfinance objective is being kind of sidestepped, I don't think we can come to that conclusion at this stage.
Yeah.
The
The last question that is there. Yeah, pardon me.
I want to add one more point.
Sure.
Clarification. Especially the cash bank and other assets are part of that 40%. For the diversification, we are hardly having 10 to 15% of our entire balance sheet. It is the other assets are also part of that 40%.
Thanks, Vivek. The next question, I think it is addressed to both people on the operational, but I'd want Shruti to weigh in a bit, and then I'll pose the same question to you, Sadaf, and then we can wrap it up. Shruti, how do you look at fintechs? Are they in the same ticket sizes but in different markets? Are they able to do better lending using data? How do you look at it? Because obviously they are also uploading their data onto credit bureau. And are they a competition to this model of microfinance in your reading? And I'll ask the same question with Sadaf as well, and how he sees that.
So again, with fintechs, it becomes very interesting because they are mostly digital players, and on the retail side, we usually see fintech loans as personal loans. Surprisingly, in the latest, and we keep checking for overlap, and what we define as overlap is a customer who has a presence in microfinance as well as retail. So we are seeing an increase in the overlap between microfinance and fintech retail, especially. So the overlap right now stands at around 10%. 2 years back, it was less than 2%. So, if you think about it from that perspective, it is increasing pretty fast. I think digital is the way to go. Most of the microfinance players are also moving digital. For the customers, they are becoming pretty smart. They are seeing that which are, probably the places which are offering them I'm not sure if it's just the interest rate they're looking at, but the amount as well that they're probably looking at. Um, However, and most of the microfinance institutes, I know they are doing a combined credit check. So they are looking at the customer footprint, both on the microfinance as well as the retail side, to ensure that the risks are well managed. And I think fintechs are also realizing that that is becoming critical, because up until now, I don't think fintechs were looking at the microfinance footprint as much as the microfinance companies were. So to that extent, I think fintechs are a little more, they're not as risk averse as the microfinance institutes, because while they are doing a complete 360-degree check, fintechs are not. They're getting to understand that, and the results are surprising to them as well, that there's so much of microfinance footprint on their portfolio. So I think it's important to look at a 360-degree view, but I think I think the microfinance institutes are very, very well entrenched. They know the customers very well. While we say that digital is the play, but the fact that they had this touch base with the customer, I think that's and the fintechs have a lot to learn, is what I feel. Though there are the digital aspirations which I think would work well for the microfinance industry. That's my take on it. But I think the microfinance portfolio is better behaving than the fintech portfolio in terms of delinquency and overall loan tenure and all.
Thank you. Thank you for that insight, Shruti.
Yeah.
Sadaf, let me sort of reframe the question a little bit for you. I mean, it's the same, but two things. One, do you see this, use of data and technology as the next leap forward? Since we are talking about moving away from the typical high-touch model to select customers getting higher loans, would data help you? One. Second is, what is your reading of the quality of data, given that we were in a regimented architecture, and therefore possibly if there was a stress at the local level, we might not have captured it essentially because of the regimentation of the microfinance model. So I'll put these two additional tadka to the question. And
No, very relevant, I think, Sriram. I see fintech as an important ecosystem player, and I see them not as competition, but as an element which pushes the innovation forward. And I think banks have learned from them. A microfinance institution has an opportunity to learn from them. They are like you sometimes need a different kind of a mindset to look at the problem and solve it. I think fintechs generally possess that, and they are able to find a lot of solution. Of course, there are drawbacks of each thing. I think the concept that RBI was talking about and Vishwanathan sir mentioned is harmonization of regulation, which is essential. If we need to protect the consumer, the customer, then the regulation should be equally applicable to both. But I see fintechs as an important player, and I see that aggregator platform as a very important ecosystem thing, which can provide a lot of information about borrower, and we can learn and we can innovate. And I think if fintechs can fast track the innovation, that may take a lot of time in microfinance segment because our DNA is not that. So I think definitely it is a need. But I think they're intermediaries or a kind of parties to the whole ecosystem, but independently, whether they will be able to do it in the current regulation, that I don't see that happening. But I think the customer connect that microfinance has, and if they are able to adapt to the technology that fintech brings in, I think it'll be the ideal solution. RBI has created the good ecosystem for that. I think that would be the ideal solution. And we were talking about pricing. I think pricing can also be reduced if fintech innovation can be used for micro lending, not only lending as well as collection. And the cheaper source of fund is also aligned because operating cost has so much room, but bigger room is there in the cost of fund if that is kind of passed on, and we can use some sort of a fintech model to raise that capital or raise that money. That is also important. Coming back to the second question that you asked in terms of data quality, Shruti, I would not blame you guys. I should make a full disclosure here. I was a part of a credit bureau task force from 2010, and whatever has happened is I'm equally to be blamed. So we have done it. But I think from where we were to where we are today, a daily submission of almost 60-70% of the data is a great achievement. But to say that is it everything is hunky-dory, I think there is some room. I think there is SHG data which at an account level is missing, which needs to come in. There are smaller unregulated players who are there. Their data needs to come in. The data on Kisan credit card and other things are not absolutely clear in terms of how do you make a interpretation whether the credit behavior is there or not.
Sadaf, just one small intervention because we don't have too much of time. Is the quality of the data that you are uploading itself good? That is the question that I was asking.
Yeah, I think from an MFI perspective, we have achieved almost, I think, I would not fall short of saying almost Six Sigma on that in terms of submitting data. Of course, different.
No. Is the quality of data that you're collecting, your delinquency data, is it really the delinquency, particularly in a regimented model? That is the question that I'm asking.
Yeah, so Sriram, today's microfinance is very different than earlier. It is all system driven. RBI has made it like the recognition of NPAs on a day-wise basis. So you can't really do away with it, and you're submitting data to Credit Bureau. Shruti can vouch for it on a daily basis. So if report something yesterday and I report something today, that's not possible. So everything is out there. So I think to a large extent, I would not rule out somebody doing some mischief, but to a large extent, the data quality, at least from an MFI sector, is pretty good.
Okay. Thanks a lot. I think we are almost time up. There are a few more questions and comments, but particularly relating to qualifying assets and things like that. We've already discussed some parts of it. There is some nuance left over, and some of these are repeat questions as well. So we can sort of move on. Just 2 minutes. Vishwanathan, you would like to say something as final words?
Sir, you're on mute.
You're on mute.
The only point I want to say, I think, to the last question itself, is that there is no harm in looking at the data beyond what is regimented. See, the Reserve Bank has said this is the minimum that you must look at, right? So adapting or adopting other models to look at, for example, information about a particular location, right? Is that prone to, say, let's say, more floods? Is that prone to drought? Those kind of information being added to what an MFI uses to look at credit borrower behavior. I mean, borrower behavior, I don't think there is any restriction on that. So I think the MFIs will be well served by going beyond just credit bureau data to make an assessment.
Yeah. Thanks a lot, Vishwanathan. I think on that note, we can possibly call this to an end. One possible thing is whether we can do a deep dive into delinquency and see whether that quality of the data which was uploaded itself was good. I mean, go back to the clients and see what their economics were. I mean, possibly that might be a nice way to enter this. I will just stop here and hand it over to Gigi because there's one question, Gigi, which is provocative towards you. So you can take that question, answer it, and wrap up the session. The question is, will Sa-Dhan and Access keep doing these seminars, or will you do something more about it? So please answer that question, and we can call this.
Yeah. Thanks for that question. In fact, this is only a beginning in the sense this is only to get some kind of views from the experts, but definitely we have our own work to do. And some of the issues which have been raised, in fact, even Vishal has suggested certain things which we need to work on that, and we'll be working. And we had been working with that. In fact, recently also we met the DG. That time we raised certain issues. One of the issues which we raised was probably it did not come in this discussion also. See, in the recent or if it's the past also, because of the delinquency increasing in the delinquency, many of the smaller borrowers of microfinance institutions are going out of the system. They have become delinquent and they are unable to get credit from any of the regulated entities because, in fact, their data in the credit bureau shows that they are delinquent. In fact, I am seeing some of the, if you see the 180 plus data, which showing around 12%, which includes the data of even Andhra crisis. Andhra crisis is there, COVID, the demon time thing is there, COVID is there. It's a cumulative of all these things. Unless the lenders report to the credit bureau saying that the account has been written off, it has been settled, or it has been written off or something like that. They're not, unless that is given, they are not able to do that. In the process, many of the smaller borrowers are going out of the formal credit system, and it becoming a financial exclusion in the process. So recently, when we met the DG, we taken up this issue. Can we have some kind of a restructuring for these loans, and some kind of a restart for restarting the new business?
Restaurant.
So we had been working on this. I'm saying that this is something which we recently done. Definitely, whatever the points which have come through, we will be taking forward, and we will not stop it with this webinar. Thank you so much.
Yeah.
Thank you.
Great
So
start.
Thank you.
Yeah,
thank,
Vipin,
thank.
Vipin
I
wants
will
to say.
request Vipin to maybe say a few words. Vipin.
Well, I'll just help to conclude it. I think we had an
Sure.
excellent discussion on a lot of issues. Of course, the high point is that the sector is, returning to normalcy. So that's really good news. But a lot of other very interesting insights came out of this discussion. And I think, Gigi, it's up to you and us to sit together to see what we need to kind of, just a discussion and then some ideas and all that is not going to help. So we need to kind of regroup to see what are some things that we do a deeper dive on, and maybe make some recommendations. Some of the recommendations may be for the regulator, but others for the sector. So there were quite a few of those that came, and I must really thank the panel. Of course, Sriram, as always, deftly moderated webinar. Thanks, Mr. Vishwanathan, Vivek. Thank you so much. Sadaf and Shruti, thank you so very much. I think it was very good. And I must thank the over 200 participants who logged in and who stayed throughout the 1.5 hour with this discussion. And Sriram, we are going to, come back to you again to look at what are other cuts in the sector that we need to look at. So there is a whole lot of stuff. I mean, we haven't talked about seeding more innovation. How do we harness AI? Looking at ticket size, is that a good thing, or we need to rethink on those issues? So there are quite a few issues here, and we will collate them at our end, and then maybe on one or two specific themes and cuts, we may want to reconvene. But thank you so very much, everybody. It was very, very useful for the sector, and looking forward to us, when we do the next webinar. Thanks very much.
Thank you very much.
Thank you.
Thanks, Vipin, and thanks to all the speakers. Just to adding on to what Vipin said, so we have our Global Inclusive Finance Summit this year on January 13th and 14th. 2026. So to run, as I mentioned earlier, also running up to that particular summit, we will be having a series of webinars every month. Probably next month also we are planning to do one of them, and we need support from the speakers as well as Sa-Dhan to specify on a particular topic, theme, and what kind of discussions need to be happening in that. So that is will be happening in the next 2-3 months. In addition to that, in addition to thanking all of them being together yesterday, we had a pre-panel discussions. Everybody took out time, discussed with each other. So just to add on few people, I would like to thank my uh, the New Make events who are the event managers for this. They did a really great job for doing this very seamlessly. In addition to that, my team, Akash, Satyan, as well as the comms team, Tanya, Sonali, and Ravi, who not only worked on the creatives but also worked on the seamless working of the webinar. So thank you everyone, and thank you very much. Thank you for the participants for being there all throughout for 1.5 hours. So thank you all.
Bye.
Thank you. Thank you so much. Thank you.
Shweta, we can end the